While the war in Ukraine is in day 25, leaders around the world are looking not only to stem that two-nation conflict, but they're also looking for ways to stem inflation, which threatens to derail the economic recovery that started post-pandemic. They're big subjects being dealt with all around the world today by central banks and governments alike. I'm Kent Kramer. I'm the Chief Investment Officer at Foster Group, and this is our biweekly financial perspectives, where we look at events surrounding world economics, as well as what's happening in markets. And we look at things that may be of interest or importance for investors to consider. Let's look at markets to date first. In terms of year-to-date returns, they've been negative, which really kind of makes sense when we talk about things like inflation getting higher, I think, than people imagined, interest rates likely going up this year, and then you drop in the conflict in Ukraine. There's a lot of uncertainty that's just come to the surface, and it's caused investors to be a little less optimistic. And you can see that in the returns in all the different markets, stock and bond, as they're reflected around the world. In terms of post-invasion markets, so how have markets responded since Russia invaded Ukraine? Well, things were not looking very good for the first few weeks, but then last week, I think people began to think maybe there's hope for an end to this conflict, or maybe markets had overreacted a little bit, but we saw in the last week a pretty good recovery. You can see that especially the pink line, which is the emerging markets index. This is where you find China and Russia. China chose to step in to support their economy, causing their stock prices to rise. So you saw a pretty steep increase in stock prices, particularly in China last week. This is the person who's been in the headlines, Jay Powell. He's the chairman of the Federal Reserve. And he and his other Fed board governors have been telling us for months and months and months that interest rates are going to rise. They're planning on doing that soon to fight inflation, which has come into the fore in most newscasts, and we've seen it in lots of different places. So what does that mean? Well, for you and I, some things cost more now than they did a year ago. Oftentimes you'll hear people talking lately about crude oil prices because of what's happening in the oil market. Well, we're not consuming barrels of oil, we're consuming gallons of gasoline when we go to the gas station to fill up our car. And what you can see here is the price of retail gas and how much it's increased over the last year. It's up almost 49%, rising to $4.41 per gallon on average in the United States. That means no matter what kind of car you drive, unless it's an EV, you're paying a lot more to put gas in your tank week after week or month after month. When we talk about inflation, we need to think about things in terms of year-over-year numbers. Sometimes that's not clear when they say the CPI was 7.5%. What does that mean? Well, they're looking at what that same index was 12 months ago, and then looking at what it is today. And that index is really a basket of goods. And so when we talk about year-over-year price changes, here's an example of new cars. The average new car in January of 2021 cost $41,304. That same average new car in January of 2022 rose in price to $46,404, an increase of 12.2%. So new car inflation year over year was 12.2%. The other thing that we need to keep in mind when we talk about inflation measures is the Fed uses one measure, and you'll hear this talked about in the news periodically, but we consume really based on another measure. The Consumer Price Index is the basket of goods that most of us consume, and it includes food and energy, among other things. The US core inflation rate, which is what the Fed looks primarily at, and sometimes they'll talk about that rate, it actually excludes food and energy from the measurement. So that may seem a little strange to you because, well, for most of us, food and energy represent a large part of our budget, but both of those parts of the budget, both food and energy, tend to be very volatile price indicators from month to month. And so the Fed chooses to strip them out and try to look at the kind of a base or a core rate of inflation when making economic policy. So here's a nice picture that was in the Wall Street Journal a few weeks ago of the components that make up the Consumer Price Index, or CPI. And this you can see showing the January CPI number of 7.5%. Again, showing a year-over-year number. So from January of 2021 to January of 2022, the basket of goods rose on average 7.5%. Now, I just said that oil prices were up almost, or gasoline prices were up almost 50%. And new car prices were up over 12%. So how can the inflation number just be 7.5 or 7.9 as it was at the end of February? Well, the reason is because energy, let's take that one. Energy represents about 7% of the average household's budget, what we spend on the average month. So if I take 7% of my spending and apply to that a 49% increase, you can see it really doesn't contribute 40% to an inflation rate. It contributes some fraction of that. It's the contribution, that's 7% of our spending. And that 7%, yes, cost did go up 40%, but it's only 7% of the total dollar that we spend. Same thing down in used cars and autos. I talked about new cars going up 12%. Look at used cars. Used cars were up over 40% year over year. But again, our spending on car acquisition as consumers is only 7% of the average household budget. So even though one section of the consumer price index went up a lot, cars or energy, the overall blend of that consumer price index is a function of how much we spend on each category of good and how much that category of good rose in price year over year. Regardless, 7.9% is the highest number we've seen in 40 years for inflation. That's going back to the 80s. For some of us, we remember the 80s. For some people listening, you weren't alive in the 80s. It's been a long time since we've seen inflation on that level. At the beginning of this inflationary cycle, the Fed said they expected it to be transitory, meaning it would come and go rather quickly. Well, they've kind of retraced their steps and said maybe it won't be as transitory as they thought. It might take a little bit longer to run the full course. And there's some good reasons for why it may take longer. Some of the things we're just learning because this is the first time we've been through a pandemic where we shut down whole sections of the economy, and it takes a while for those sections of the economy to turn back on. Again, I'll just talk about automobile production. We shut down lots of automobile producers because workers needed to stay home in order to be safe from the coronavirus pandemic. Well, finally, those workers come back to work at the manufacturing plants. And you know what? They need parts as well as their labor to assemble new cars. Well, semiconductor plants, chip plants in Taiwan and other parts of the world, they were shut down as well. So all of a sudden, these workers who are ready to go back to work assembling cars, they don't have the parts they need to assemble the car to get those new cars to dealer lots. What that means is it's just going to take longer for the supply of new autos to be replenished. In the meantime, the demand for those new autos is high because consumers are sitting on record amounts of cash in their savings accounts wanting to spend on things like cars and travel and other things. The point here is our demand came back very fast. We had pent-up demand as consumers. We want to get out and do things. We have money to spend, but the supply, the things that we can buy or the places we can go, they've come back more slowly. That means inflation may take a little bit longer to work its way through the system. One kind of helpful way, I think, to think about this just in terms of that supply and demand contribution to inflation. This chart just shows different areas of consumer spending, parts of that consumer price index, and the pressures associated with supply and demand and what they do to the inflation of prices relative to those sections of the economy. We talked about autos. The idea there is we're in kind of a high demand period with a relatively low supply. So when you have that, prices tend to move above equilibrium. In other words, prices go higher because there's more demand than there is supply. A year from now, if we think about that light gray line, there will likely be an increase in supply. Auto manufacturers will be back up to speed. They'll be producing more autos. We as consumers will have spent some of that cash, that record cash we've accumulated, so there might be a little bit less demand. Both of those things combined should decrease the rate of inflation associated with new cars. Let's look at workers for a minute, because this is an interesting one. This one actually may remain elevated. One of the things we've seen happen as we've come back from the pandemic is a lot of workers have left the workplace, maybe permanently. So as companies come back and are looking to hire, and they're looking to hire aggressively, what they're finding is there are more jobs available than there are people to fill them. And that's both people who are working and people who are unemployed. There are just more jobs available than there are workers in the workforce. That imbalance could persist for a while. And when that imbalance persists, there's a lower supply of workers, higher demand for those workers, it causes wages to rise. If wages rise and stay significantly higher, that could lead to inflation kind of settling at a higher rate than it's been in the past. The Federal Reserve has been thinking this was going to probably happen since 2009, and they've wondered why it hasn't. It may have taken an event like the pandemic to actually push wages, real wages, higher in a way that they'll stay higher. Now, the Fed's also talked a lot about interest rates. Go back to where we started. One of the reasons they've been in the news is because they raised interest rates a quarter point. The interest rate, they only control one interest rate, but they raised that interest rate last week a quarter point. They've been telling us that they've been going to raise interest rates for months to prepare for it. And markets have been preparing for it in anticipation of the Federal Reserve raising rates. Rates in the market have already begun to gone up. And in some cases, those rates have gone up significantly. Look at the average 30-year fixed mortgage rate. In the pandemic, in the middle of kind of coming out of the pandemic in late 2021, you saw mortgage rates drop below 2.75% for a 30-year mortgage. They are already up above 4%. So they have risen quite a bit here in the last few months in anticipation of interest rates generally going higher. So what does that mean? Why would the Fed want to raise rates? Well, when the Fed raises rates, the cost of buying things actually goes up, particularly large purchases like homes. Most people have to take out a mortgage in order to buy a home. If the cost of money, if the interest rate associated with your mortgage is higher, the same house is going to cost you more on a monthly basis because now your mortgage interest associated with what you borrowed to buy the house is as much as twice as high as it was just a year or two ago. That causes the prices of homes maybe to not go up as fast. It also causes people to think twice before buying that new home because that mortgage rate is higher. Both of those things tend to slow down the housing market a little bit, which slows down the rate of inflation, slowing down the overall economy. You can see the other rates in the right-hand panel. These just represent investment rates of interest. For some investors, higher interest rates actually are going to end up being a relatively good thing because they're going to be able to hold bonds and their cash is going to pay more interest. That's going to be good over time, but in the short term, sometimes raising interest rates can have a little bit of a depressing effect, a slowing effect on financial markets as well. And that's where it concerns us as investors, I think. Well, what are the potential implications of higher interest rates? That's a subject for a whole nother one of our financial perspectives. And we're going to talk about that in 2 weeks, particularly as it relates to bond markets, who have seen quite an impact relative to this anticipation of interest rates going higher. But you can see that initially raising interest rates tend to have a slowing effect, not only on the economy, but also on investment markets as well. The question some people ask is the medicine or the cure, is it actually worse than the disease, inflation? In other words, are the higher rates, are they worse in terms of their economic impact than inflation? In the past, inflation has been the thing that we need to worry about the most. And as inflation gets to 40-year highs, it seems like the Federal Reserve may be in time or maybe even a little bit late in terms of trying to get inflation under control. So we look forward to seeing you in a couple of weeks when we'll be talking about those bond markets and interest rates, and hopefully we'll see some resolution to what's happening in the Ukraine with Russia withdrawing. But until then, thanks for attending today. If there are particular questions you'd like us to address, either about bonds or interest rates or inflation, please let us know. We'd be happy to address those things. You can see some contact for us, information for us on the screen here. Also, if you want to get together with a Foster Group advisor and talk about your portfolio or talk about the economy, your financial plan, whatever it might be, we'd love to have that conversation. Our advisors are always ready to meet at a time that's convenient for you. So we hope you'll take advantage of that as well. So until we see you again in 2 weeks, we hope you're well, and we'll see you then. Thanks.